Now you guys have seen my long-term buy and hold portfolio here on YouTube, but what you haven't seen yet is my options portfolio that I use more for trading on a weekly basis or monthly basis, and it's really for swing trading. Now I also trade on both sides of the market for this one, so short-term bearish plays or bullish plays. In this video, I'm going to talk about how I manage this portfolio, some of the stats that we've seen since the inception of it, and then going forward, similar to my long-term portfolio, I'll be walking through kind of updates with how the options portfolio is doing, how I'm adjusting my portfolio and strategy for the current market as it is a little bit more active and short-term based. This portfolio is not as large as my long-term buy and hold portfolio, but currently it's sitting at around $12,000. And you've probably seen this screen before. This is Tastyworks, and in my opinion, they are the best platform from a user interface point for trading options. It gives me everything I want to set up trades. It's really easy. So I'll probably do a Tastyworks review later, kind of going over all the features that I like. But this is the portfolio. So currently sitting at that number. And right now I'm in 6 different plays, and most of them are bullish. With the recent sell-off, I don't have any short delta in the portfolio. These are all really bullish plays. The only short delta hedge I kind of have is in my Coursera position, which is a covered call. If this stock goes down, I make money on the call. But overall, everything right now is bullish. With that being said, a majority of my plays are either shorting puts and potentially putting that into the wheel strategy, selling call spreads or put spreads, and then also selling things like strangles or selling something like an iron condor. So for the majority of the time, I'm selling credit spreads as well as short puts. And then once in a while, if something really crazy happens and there's a ton of volatility, maybe I'll sell a strangle, but there is some undefined risk in that trade. Usually I tend to trade defined risk, which means I know how much money I can make and lose at the beginning of the trade. It's also important to remember that I am selling options. So if you look at Wall Street Bets or a community like that, they are usually buying call options or buying put options, and their hope is to have the stock go in their direction in a specific period of time. For me, I'm selling options. So I tend to want to make money from time value coming out of the options, so theta decay, or selling options when implied volatility is extremely high, there's fear in the market, and then once that uncertainty comes out, I make money from the IV contraction. Now, don't get me wrong, both strategies have their pros and cons, and they can both be profitable. For me, I choose selling options, and I like to use an analogy using basketball. Selling options to me is more like shooting free throws. It's a high probability chance, and you score a small amount of points, but over a long period of time, that can add up to a decent amount of money. Whereas buying calls is like chucking up half-court shots and hoping that one falls in out of every 10 trades. So you lose on most of your trades, and then you hope for that home run play that makes you a majority of your money back and then some. So I started this portfolio back in June of 2020. What I did is I compare my portfolio results versus buying something like the S&P 500, because the whole point of any portfolio, I want to be beating the S&P 500, because at the end of the day, we're trying to generate some alpha for putting in this work. What's nice about my strategy is I can put on a trade and walk away from it for weeks and not have to manage it. I just put in what I want to make on the profit side, and then maybe I'll check in on the trade 2 weeks later. Whereas something like day trading or stuff like that, you have to constantly be looking at it. Most of the work comes from looking at charts and technicals to actually get into the trade. But once you put it on, you set your profit and you kind of forget about it. But anyway, for the total deposits, right, for the portfolio, currently close to 9,000. And this is from my weekly report that I send out for my Patreon, if you want to check that out in the description below. But basically, I've made around 35% since the beginning of this portfolio versus the S&P 500, around 26% on an equivalent basis. And the funny part is that most of the money that I've lost this year is in short delta positions. When the market is constantly going up, I don't do as well just because I tend to be a little bit of a contrarian. So when there's a lot of fear in the market, that's when I tend to lean bullish. And if the market is in a euphoric state, that's when I tend to lean a little bit delta neutral, put on some short delta positions. But this year and 2020 has been a massive bull run. That's the situation where we don't really see that sideways market where this portfolio may really outperform. I've kind of been just keeping up with the S&P 500 this year. That's kind of one of the downsides. If you're in a super bull market, my strategy may just keep up or actually kind of fall behind. Whereas if the market goes down or it kind of trades sideways, that's where my strategies can outperform. And I definitely have some rules down here that I try to follow from an overall portfolio basis. And so one is keeping a certain amount of theta in the portfolio. So this is how much time decay on a daily basis that I'm trying to keep. And I usually try to keep it at least a minimum of 0.1% of the overall portfolio value. So at 12,000, that would be a theta of around 12. Now the delta of the portfolio, this is what I would manage on more of the thesis on where the overall market is going in the short term. So this is a situation where I'm looking at the S&P 500. At this point, I'm leaning a little bit bullish. So I'm bullish on the market. I think it has some room to run to the upside after really having a lot of support at this 430 level. The Fed basically coming out saying nothing has changed on the tapering, and the whole Evergrande situation I think is a little overblown. This fear-based drop, this is when I was leaning more long delta. And then right around kind of this 450 area over here, this is where I had some short positions on, and I'm playing both sides of the market. Being the one that's selling options with theta decay, if the market also goes sideways, I make money. Something else I look at a lot for this portfolio is just the overall VIX, which tracks the volatility in the S&P 500. And this usually gives me an indicator of if I can collect more premium or maybe I should take some risk off. On Monday, when the VIX really exploded to the upside, this is where I start to think, okay, we may be at a consolidation point or we're kind of oversold. And you pair that with where the S&P 500 is, and that's where I can kind of get a sense of I want to lean bullish right now because everyone is panicking and the S&P 500 selling off. Of course, you have the situations in March, you had a massive sell-off from an event that has never happened. Black swan event can keep on having the VIX explode. And that's why when I'm getting long, I don't want to put on too much leverage. I want to have any positions like short puts. I want to have cash to be able to buy the shares and sell calls against it. At some point, if I'm still bullish, but I don't want to sell any more puts, that's when I would switch to credit spreads. And that would reduce the amount of buying power that I'm locking up with specific trades. With all that being said, we can kind of look at the positions that I currently have on. 5 out of the 6 are short puts. This is where I'm selling a cash secured put. And if everything got exercised, I would still have enough cash to buy the shares. And that's kind of important for me because I don't want to over leverage this portfolio, meaning I'm not trying to sell 20 puts in Bank of America and having myself be assigned and all of a sudden I have a $60,000 position. It just doesn't make sense. So that's one thing I'm also looking at is the buying power that I'm using and to make sure that I'm not blowing up my account by overdoing it on the leverage piece. Something else I try to avoid when selling puts is to have concentration risk. With a portfolio of 12,000, I'm not trying to sell a put in AMD at a $100 strike price because if I'm assigned, that's a $10,000 position. Really what I want is a bunch of smaller positions in good stocks, right? I'm still looking for stocks that I think are undervalued, but I don't want 100% of my buying power in one position because if something happens to that one company, it can take down my entire portfolio. If you couldn't tell, I like selling puts. And the reason is I have the ability to manage those positions pretty well. Also, if I want to buy a company for a swing trade, basically, I'm selling a put to get paid a certain amount of money to buy that stock at a discount. And then if I think that stock's already undervalued, I'm just holding on to the shares and selling calls back at where I think a reasonable price is. Looking at the fundamentals of the companies that I'm trading is extremely important to me because I'm not trying to sell a put at an elevated valuation for a company like Bank of America. If I think it's worth $50 per share and it's trading at 40, selling a put, I feel like I'm minimizing my risk by selling a put. And then also I'm kind of hitting a floor because I think it's worth $50 per share. Whereas if Bank of America is trading at 55, I think it should be worth 50. Well, I'm not touching that thing because I don't want to sell puts and have it crash to a floor like $40. And so that's kind of how I operate when it comes to selling puts. I want to limit my ultimate downside risk by not selling puts and stocks that I think are overvalued. Now, I also take that fundamental information and use it for short plays as well. So if I'm really bearish on a position and it's gone on a huge run and the RSI is showing that it's overbought and the IVR is still high, well, now I can take a bearish position on that stock and neutralize my whole portfolio and play both bullish positions and bearish positions where I can be right on both. Now, of course, I'm not a god and I can't get the directional plays perfect 100% 100% of the time. That's why I love the fact that selling options, you get a little bit of a buffer with that time value coming out of the options or the theta decay. If you're wondering how many positions am I putting on a monthly basis or a weekly basis, looking at 2021 and all the positions that I opened, it was around 71 positions that were new or I opened. And if you divide that by 9 months, we're talking about around 8 positions that I'm opening each month, or on average around 2 per week. Nothing crazy in terms of putting on positions. It's not like I'm selling and buying 20 positions each day. Something else that I have to do with this portfolio is look for new plays to put on when I'm taking old positions off. So if I want to keep those theta numbers at a certain level, and I have profitable trades that come off, let's say around 50% profit, well, now I'm looking for new plays to put on. But yeah, that's how I manage the options portfolio. Definitely a different thought process and a lot of behavioral finance, in my opinion, when it comes to trading in the short term or short to medium term. If you did enjoy this video, make sure to give it a like, as well as consider subscribing to Main Street Wolf, where we talk stock options, investing, anything to do with money. Thanks guys for watching, and have a great day.